Hi, everybody. Can everybody hear me?
Yes. Can we wait more 5 minutes? Yeah.
Absolutely, not a problem.
Yes. Thank you.
All right, are we ready to start?
Okay. Can we start?
Perfect. So let me get started on this right now. Hold on a second. Um, Let me see if I can start the slides. Uh, Slide. Start from beginning. Can everybody hear me okay?
Yes, we can hear.
Okay, perfect. Let me get this. Close all the browser. Perfect. Okay. Hey, everybody. Welcome to Asset Preservation's 1031 Exchange webinar. Thank you very much for having me here today to do this presentation. My name is Wei Ming, and I'm a division manager with Asset Preservation Inc. Now, before anybody asks, we are a 1031 exchange company, oftentimes referred to as a 1031 exchange facilitator, a qualified intermediary. The only thing we do are 1031 exchanges. We do not do anything else. We're not escrow. We don't help clients sell their property. We don't help clients purchase replacement properties. We are simply the exchange company helping them to facilitate their 1031 exchanges. Now, before I dive into that, that's what my disclaimer is for. I'm not a CPA either. I'm not a financial advisor. So oftentimes during my presentation, I will mention clients having to go to financial or tax advisors or CPAs in order to get specific information. The information I give you today, that I present to you today, there are more general information that encompasses the general clientele. And any specifics, we can either talk offline or they can always consult with a tax and legal advisor as well. Now, diving straight into it, what is a 1031 exchange and what does it say in the Internal Revenue Code? It says no gain or loss shall be recognized on the exchange of real property held for productive use in a trade or business or for investment if such real property is exchanged solely excuse me, for real property of like kind, which is to be held either for productive use in a trade or business or for investment. That's a mouthful. Personally, not a fan of saying it just because it can be a little bit confusing for a lot of investors. Excuse me. It can be very confusing for some investors because this is very wordy. But essentially, what it says is if your client has a property they have been using for trade or for business or for investment, like a rental, they can sell that and buy another property that they're going to use for trade or business or for investment, like rental, and defer up to 100% of their capital gains taxes. And I'm going to show you how in my slides. Now, before we go into that, I want to cover some of the topics we will be discussing today. We'll talk about 1031 exchange changes, extensions, the type of exchanges you can use, and the key points to keep in mind if you want to have a successful 1031 exchange. And of course, feel free to type out any questions or raise your hand during the presentation. I'm happy to answer any questions you may have. Or if you prefer, you can always ask the questions at the end. I will be taking questions at the end and going over any other information that you may want. Now, let's go into changes first. I hear this a lot. I was just talking about this with a number of investors just yesterday. They were asking Wei Ming, are there any changes to 1031 exchange? I heard that Biden is trying to get rid of exchanges again or limit exchanges again. Is that true? Well, to be honest, in the last couple of administrations, they've talked about, not just Biden, but the last couple of administrations, they talked about limiting or eliminating 1031 exchanges altogether. 1031 exchanges have been around for over 100 years now. We don't see it ever going away. It is very, very beneficial to the real estate industry. And in terms of changes, there hasn't been any major changes. The last couple ones were back in '09. The government made it more difficult for you to take a full homeowner's exclusion if you move back into a property that you purchased in a 1031 exchange. So for clients who bought a replacement property, rented out for a couple years, and move into it, there's going to be a proration for the homeowner's exclusion. That was in 2009. In 2019, personal properties were no longer exchangeable. Things like collectible cars, paintings, planes, things like that. Doesn't affect the majority of clients, or you maybe not your clients, but those were really the only major changes to 1031 exchange. Now, as for extension, yes, there is, and there are extensions for clients who live in certain parts of California. I'll go over that in just my slides. I believe it actually is my next slide. So extensions. Normally, there are no extensions to a 1031 exchange. The timelines are dead set. Now, in a 1031 exchange, from the close of escrow, you do have 45 days to identify potential properties to buy, in a total of 180 calendar days to close and complete your exchange, meaning you have to purchase your replacement property, close on it in order to complete your exchange. However, due to the recent storms in California, there's been quite a few. As of March 17th, the extension, any of these deadlines are pushed to October 16th. Now, if you are an affected taxpayer living in one of these counties or have business in one of these counties, you qualify for this extension. Now, we're already in May, ladies and gentlemen. We're already in May. If you manage to close escrow today, just as an example, your day 180 would be sometime in November. However, if your client decides to take the extension granted by the IRS, their day 45 isn't 45 days from today. Rather, their day 45 is October 16th. So tell your clients this. If they are in one of these counties, they have this extension. They don't have to scramble to look for something to buy in 45 days. October 16th is what was it? It's in about a little more than 5 months. They have a little more than 5 months to look for a replacement property. Take advantage of this. Tell your clients that they have this. If they are already in the middle of a 1031 exchange, they may also qualify for this. So let them know. Tell them to give me a call or to ask me, and I can walk them through this process. Now, ladies and gentlemen, clients oftentimes ask me, Wei Ming, I understand a 1031 exchange. I understand that it allows you to defer up to 100% of your capital gains taxes. But what are some other reasons why clients may want to do a 1031 exchange? Well, it allows you to diversify your portfolio. Whether or not you're a new real estate agent or a veteran, you know that a lot of clients, in order to build that wealth, they want to diversify that portfolio. They want more and more real estate, right? You want to help your clients get more and more real estate. A 1031 exchange allows them to sell, for example, sell one property, buy multiple, or sell multiple and buy one property. Mix and match however you want it. Sell one, buy three, sell three, buy two, whatever you want. It also has the potential to increase cash flow. It's a little more difficult now with the rates being so high, but a 1031 exchange can allow your client to get out of the property that has not been getting them that cash flow that they want. You have a troublesome tenant, you have tenants who are not paying rent. Well, you can sell that property, do a 1031 exchange, and move the equity to another property, something better, something that's going to get you a better tenant or a higher return on your investment. Increase your cash flow. I'll give you a great example. I have had a client a couple years ago. He sold a commercial property in Sacramento. He ended up buying over 50 replacement properties, single family properties out of state. They were all new builds, and they more than tripled his return that he was getting from his commercial property. So was that a lot of work? Absolutely. He had to coordinate a bunch with different realtors, with different builders in different states, but he was smart about it. He utilized the exchange, and now he's easily enjoying over 3x what he was getting before. In a 1031 exchange, you're often going to hear that you need to buy a like kind property. What does that mean? Ladies and gentlemen, it is extremely broad. It means if you sell an investment property in the United States, you simply have to buy an investment property in the United States. It doesn't matter which state, what city, what town, or what type of real estate. You can sell residential, buy commercial, sell commercial, buy land, whatever you want, as long as you sell in the US and buy in the US. Last but not least, we often get a lot of referrals from CPAs as well. CPAs will often tell a client, saying, hey, Wei Ming's client, you've owned the property for over 20 years. You have been depreciating your property for a long period of time. Now, I understand that some of the real estate agents here today are also investors. If you are an investor, or even if you're a real estate agent, you'll know that for a residential property, you can depreciate for 27 and a half years, commercial properties for 39 years. So what does depreciation do for me if I'm an investor? Give you an example. If I can take $10,000 of depreciation every year and I make, for example, $100,000 a year, that's basically a write-off of $10,000, meaning I'm only taxed on $90,000. Now, ladies and gentlemen, that example is extremely summarized. There are a lot of things that go into that, but that's the general idea of what depreciation does for you, for your client. However, if they have passed that 27 and a half years for residential or 39 years, there's no more depreciation. So what do? You can then sell your heavily appreciated property and purchase even more expensive property, and that additional equity is now depreciable. Ladies and gentlemen, one of the most asked questions I get on a daily basis, and especially you as a real estate agent, you're going to get this all the time. And you're going to notice this because you're helping your clients to sell. How much money is your client making from the sale of this property? How much profit are they making? Well, the question is, how much taxes do they owe? That is, ladies and gentlemen, one of the most important questions I get on a daily basis. How much taxes does my client owe? Well, it depends. But on average, I tell my clients it can probably be anywhere from 30 to 33%, especially if you're selling in California. Now, ladies and gentlemen, it is not specifically 33%. Rather, when clients or CPAs or any real estate professionals talk about capital gains taxes, they are actually referencing 4 different taxes. These 4 comprises of what we know as capital gains taxes. They include federal taxes, state taxes, depreciation recapture, and net investment income tax. Now, oftentimes our clients go, Wei Ming, I'm only making $100,000, $200,000 from the sale of this property. That's my profit. I don't make a lot of money every year. I make 50,000, I make 60,000. So my taxes is low, right? Well, not necessarily. If you add $100,000 or $200,000 to your $50,000, $60,000 income, where is your tax bracket? Your tax bracket can potentially be bumped up from the sale of your property, the potential gains that you get from selling your property. So, ladies and gentlemen, for the exact amount that your client would owe, they would need to talk to their CPA or tax advisor. However, a good estimate is anywhere from about 30 to 33%. Let me give you an example. In this example, I bought my property for $500,000, and my CPA says in the number of years I have rented it out, I have depreciated $100,000. Now, as for capital improvements, I went to Jerry to help me with this property, with selling this property. We do all the connections and whatnot, put about $25,000 of work into this property. And we were able to sell and net $1 million. I'm going to call this sell and net $1 million in this example. In this example, there are two things I'm trying to find. Number one, I'm trying to find what my adjusted basis is. And with that amount, I can figure out how much gain or profit I have. My original purchase price is $500,000. Depreciation lowers that number, and in this case, by $100,000. Capital improvements will increase it by 25 in my case, giving me adjusted basis, my quote unquote original money of $425,000. Now I sell and net $1 million. After I subtract the original amount, the adjusted basis, I will have what's called the gains or profits of $575,000. Now, my CPA did all the calculation, and it looks like I owe the government about $197,000 and change in taxes. Ladies and gentlemen, that is just a little above 33%, but that is very close. I'm only off by a couple $100. It's very, very close to that 33%. Now, if you, a real estate agent, would like to punch in some of these numbers and play around and see what potential taxes a client might owe, or even if your client wants to do it themselves, on our website, we have a tax calculator that will do all these calculations for you. All you have to do is punch in the number, how much you bought for, how much you're selling for, and what your tax brackets are. It will do the calculation for you. Now, if you want a copy of these slides, I have provided to Christine, and she can provide you with a copy of these slides. Now, ladies and gentlemen, there are a number of different types of exchanges available to your investor. There used to be only one, and that was the simultaneous exchange. This is when you close on the sale and purchase on the same day. However, most of my clients will utilize what's called a delayed exchange. A delayed exchange lets you close on the property you're selling, have 45 days to identify, then a total of 180 days, calendar days, to close on your replacement property. There is also such thing as a reverse exchange, where you can buy the replacement property first and then sell your old property. You can also improve the property that you're buying. in a construction or improvement exchange, you can buy a property of lower value and use the remaining funds to fix up or improve on the property that you're buying in the 1031 exchange. Last but not least, we have the reverse construction. You can buy your property first, start improving on it before you sell your property. So, ladies and gentlemen, there are different types of exchanges to help meet different needs of the clients that you may have. So feel free to have them reach out to me. I can always walk them through the process to see which exchange may be the best fit for them. Now, ladies and gentlemen, let's go over the key points to keep in mind for a successful 1031 exchange. In order to have a successful exchange, I have written out 4 key points. They are property qualifications, tax deferral, timeline, and identification rule. In order for your property to qualify for an exchange, it has to be been used or held for business, investment, or trade use. Again, for most clients, that means they are renting out the property. They will need to report that on their tax returns. They don't report it, it doesn't count as a rental. Now, the other question I typically get is, Wei Ming, I hear that I need to rent it out for at least 1 year. Sometimes I hear that I need to rent it out for at least 2 years. What is the correct answer? Well, ladies and gentlemen, there is no correct answer to this, technically. The Internal Revenue Code does not specify a time. However, a lot of CPAs would recommend at least 1 year or 2 years and longer if possible. So my answer to my clients is the longer that you have it, the more conservative and safer of an exchange it's going to be. The shorter the time that you rent it out, the more aggressive the exchange is going to be. What I mean by that is the more aggressive the exchange, in the event of an audit, the more likely you're going to lose that audit. So, ladies and gentlemen, try to rent it out as long as possible before you sell it to do a 1031 exchange. Again, you also have to buy like-kind property. Again, sell anywhere in the U.S., buy anywhere in the U.S., and any type of real estate. Tax deferral requirements. What do I need to defer all my taxes? Well, number 1, you need to reinvest all the cash proceeds. And number 2, purchase equal or greater to your net sales price by replacing the debt. Well, on there with same or greater debt. What I mean by that is if I were to sell my property for $1 million, I'm going to have closing costs as well. These include agent commission, escrow fees, transfer tax, and recording fees. I know 100,000 is a little high, but let's stick with that for now. This will get me a net sales price of $900,000. I'm going to need to buy a replacement property for $900,000 or more to defer all my taxes. If I buy less than that, I will pay taxes on the difference. If I buy a total of $899,000, I will be paying taxes on that $1,000 I do not spend. But Wei Ming, what if I have a loan on my property? That's okay. The loan will be paid off once the property is sold, leaving you with $400,000 in cash. And ladies and gentlemen, do not be confused about this. Your cash amount is going to be different or can be different than your net sales price amount. In this case, I need to spend the $400,000, but I need to buy $900,000 or more to defer all my taxes. How I come up with the $500,000 does not matter. How I replace the debt does not matter. I can come out of pocket if I have $500,000 in my bank account. I can borrow from family. I can borrow from the bank. How I come up with the money does not matter. Now, ladies and gentlemen, in this case, let's say I only bought a property for $800,000, leaving me with $100,000 left over. What do? I have a number of options. Number one, I can keep that $100,000. That's fine. If I keep the $100,000, I'm going to get taxed on the $100,000. Option number two, I can use that $100,000 to buy more real estate. Because remember, in a 1031 exchange, I can buy more than one replacement property. I can buy two, I can buy three. Heck, I even had the client buy 50. Or number three, I can use that $100,000 in an improvement or construction exchange and use it to fix up the $800,000 property. Now, ladies and gentlemen, here is a question I often get when explaining these slides. They'll say, Wei Ming, why can't I just use my capital gains? I understand that my net sales price is 900. Let's say my adjusted basis, my original money is 500. My profit is 400. Why can't I just use my profit? Well, the government, when you purchase a replacement property, the government considers it basis first, gains last. Meaning you have to spend all your basis before you can start spending your capital gains. And you want to spend your capital gains in order to defer taxes on those gains. So again, ladies and gentlemen, basis first, gains last. In order to reach that, you have to spend what's on top first. Well, in that case, can I just keep some of my profit before it goes into the 1031? You can do that. However, I'm sorry, if you can keep some of your original money before it goes into the exchange, you can do that. However, the government is going to consider it gains first, basis last when you take money from the sale of your property. So a lot of times clients will go, oh, Wei Ming, I put some money into the property. Can I get that back? The short answer is not without paying taxes. So remember, what you're taking out first is not what you originally put in. It's your gains first if you're taking it, because this way the government can tax you right away. Now, ladies and gentlemen, from the close of escrow, you do have 45 calendar days to identify potential properties to buy and a total of 180 calendar days to complete your exchange. These are calendar days, not business days. So holidays will count as well. And this timeline starts from the close of escrow. Again, there are no extension to these timelines unless the IRS issues one. And they do not typically issue them unless there's a natural disaster that affects a lot of people, a lot of taxpayers. So keep an eye out on their IRS website. They will always post extensions. If you join our mailing list, you will get updates whenever a new extension is put on the website. Now, ladies and gentlemen, how do you identify potential properties to buy, and what is the process for identification? We, the exchange company, will provide you with a form, and you fill out that form with the address of the properties you're thinking about buying. Think of it like your homework. Which of the 3 rules do you want to use? And after you fill that out, what are the properties, the address of the properties that you're looking to buy? You can choose from 3 rules to identify your properties, not more than one, not a combination, not all of them. Just choose one of the 3. The first rule is called the 3 property rule. It lets you identify up to 3 replacement properties of any value. 3 of any value. The 200% rule lets you identify as many properties as you would like, but the combined value cannot be more than 2 times what you sold your property for. So Wei Ming, which rule should I use? Well, if you're not looking to buy more than 3, stick with the 3 property rule. If you are looking to buy more than 3 property, let's say 4 or more, you would end up using the 200% rule. And I typically see the 3 property rule used in California because the prices are so much more expensive in California. But if you're using 200% rule, trying to buy as many properties as you can with your money and leverage it, most clients use a 200% rule because it's more bang for your buck. Because if I sold a property for $1 million, that's probably just 1 property in California. So I can pick up to 3. Whereas if I sold for $1 million using a 200% rule, I can only buy a total of $2 million worth of real estate. If I went to Texas or Florida, I can probably get 4, maybe even 5 properties if I leverage it correctly. Last but not least is the 95% rule. Very hard to use, sounds easy, and it sounds great, but it's hard to use. I typically see it in portfolio transactions. The 95% rule allows the client to identify as many properties as they want, no limit to the value, but they must buy 95% or more of the total value of all properties identified. Meaning, even if I sold for $1 million, let's say I identify $100 million worth of stuff, worth of real estate, I better buy $95 million or more of it, or my entire exchange fails. So, ladies and gentlemen, I typically only see that with portfolio transactions. So for most clients, they are not using this rule. They are using one of the 2, the 3 property rule or the 200% rule. Ladies and gentlemen, now here is the final slide that I want to go over with you. In this slide, it talks about the pros and cons of a 1031 exchange. If you get anything from my presentation today, this is the slide I want you to take away with you, because it gives definitive numbers that a client can see for the benefit of an exchange or no exchange. Here's what it looks like. I'm using the same numbers I've been using throughout my presentation. Sales price $1 million, my basis is $425, so my gain is $575,000. If I say my capital gains tax is about 33%, if I do a full exchange, I don't need to pay any taxes yet or any taxes now, but I still have to pay my closing costs. This gives me, ladies and gentlemen, $900,000, assuming I don't have a loan on this property. This gives me $900,000. What's so good about an exchange? What's so bad about an exchange? The good news is I have $900,000 I can use on real estate. I can buy real estate with it. I can have an investment property. And I defer my taxes. What's so bad about it? Well, I can only buy real estate. I can't buy anything else. I can't buy a car. I can't buy a business. I can only buy real estate in a 1031 exchange. And ladies and gentlemen, let's just say, for example, the real estate is giving you a 5% return. As an example, that is $45,000 in rental income a year. Just again, just as an example, 45,000. Now let's take an example of somebody considering not doing a 1031 exchange. All the numbers are the same. The only difference is they're paying taxes of roughly $197,000. That was my tax bill, ladies and gentlemen. Remember my $197,000 tax bill. On top of that, I have to pay my closing costs. At the end of the day, I will have a little more than $700,000 to work with. If I'm going to be buying real estate anyways, I'm short $200,000 versus the 900. Who's going to win that offer? The 900. That $700,000 isn't going to win me that offer against a 900. $200,000 is a lot of money. Well, here's what a lot of people will argue. Well, what do you mean? I can put this in the stock market. Absolutely. You can put this in the stock market and you might be even be able to get better return. Let's just say 7%. Great. What's 7% on $700,000? $49,000. Is that more than 45? Absolutely. It's more than the $45,000 in rental income you'll get. However, in stocks, unless it's dividends, you're not getting that $49,000 right away. You have to sell your stocks to realize that $49,000 gain. You have to sell it. I can't get a mortgage or a loan or refinance against stocks, but I can do that with real estate. Yes, real estate and stocks will both appreciate potentially over time. Stocks up and downs, but with real estate, over time it appreciates in value. So, what are the pros about not doing an exchange? Well, I can do whatever I want with the money. Invest in stocks, buy a car, buy whatever I want, buy a business, start a business, whatever it is. I can do that if I don't do the 1031 exchange because I'm not limited to just real estate. I can do whatever I want with it. But the question then becomes, how long is it going to take you to recoup almost $200,000 so that the money continues to work for you? It's going to take you a much longer time. So, ladies and gentlemen, that concludes my part on the 1031 exchange. However, before I start taking questions, I do get questions on how the government knows you have done a 1031 exchange. You do file these forms, these two forms, and that is 8824. It's 2 pages. It asks you about your 1031 exchange. Where did you sell? Where did you buy? How much was it? How much taxes did you defer? Everything. Your CPA can help you fill out that form. It is a 2-page form that you file along with your tax returns. Now, if your client is buying out of state, there's an additional form with that. That is called the 3840, often referred to as the California clawback. Every year that you own the property outside of the state of California, California wants to know that you still own it. So they want to know because by doing a 1031 exchange, remember, ladies and gentlemen, you are also deferring state taxes on it. So that's why California wants to know every year you own it. So as soon as you don't own it anymore out of state property, they're going to ask, they say, Wei Ming, do you still own the property? If no, are you doing another exchange? If you're not doing another exchange, we want our tax money. Now, ladies and gentlemen, I am sorry, one last piece of very, very, very important information about a 1031 exchange. What is the end game? What is the end goal for a 1031 exchange? Well, the end goal is to build wealth and to leave it for your future generations. A 1031 exchange allows you to defer your taxes indefinitely. As long as you keep on doing exchanges or you don't sell your property, the taxes are never due. So in my case, let's say I do exchanges for the next 20, 30, 40 years, and I can go from owing the government 100,000 here, another 100,000 there, maybe $500,000 here. At the end of my life, I could owe them $2, $3 million, for example. When I pass away and I leave it to my heirs, whoever I leave it to, they don't have to pay any of the deferred taxes I have accumulated in my life. So I have basically used this tax money to buy myself more real estate, to buy myself better real estate, so that the money is working for me. And when I'm no longer here, I'm no longer around, well, my kids don't have to worry about paying any of that back. So, ladies and gentlemen, that does actually conclude my presentation on 1031 exchanges. If you do have any questions, I am opening up the floor for questions. Please feel free to unmute yourself or type in any questions that you may have.
Hello, Wei-Ming. What's your contact info?
I'm sorry?
What is your contact info?
My contact information. Great question. My contact information is here. The easiest way to reach me is my cell phone. Text me, call me, however you like to reach me. The best way is my cell phone and then my email address.
Oh, you was mentioning before the in cap cannings that can defer like October. You don't need a 45 identify the property, right?
You do not. So if you are taking the extension, that goes all the way to October 16. So even if you sell right now, your day 180 isn't extended to October 16. If you sold a couple months ago, it would have extended a little longer for the 180 days. But your day 45 is now October 16. All you have to do to take that extension is to let us know. Just write an email to us or give us a call and say, Wei-Ming, I qualify for the extension. Please make a note on your file. That's it.
Okay, I see. Is as a real estate agent, we just connect you and the clients, right?
Absolutely. So I'll do all the process and walking through the clients and everything. And once I do that, I will summarize everything we discussed, including how much they would need to buy to defer all their taxes, and any additional information you need onto an email. I'll make it easy for everybody. I'll make it easy for the real estate agents. So all they have to do is know what target number the client needs to buy for to defer all taxes.
Okay. And so there's no effect as, for example, the seller want to sell, and for example, there is no any effect factors about the buyer side, right? Just they need a cooperation with it, and
Yes.
transaction needed to, if for example they close in 30 days, or so.
Yes, so you are correct. There is no additional cost to the buyer if your clients are the sellers. So oftentimes I will have clients who put in the contract seller to do a 1031 exchange at no cost to the buyer. So it doesn't cost the buyer anything. They're just letting them know, say, hey, the client's going to be doing a 1031 exchange, and it only affects their part, nothing else.
Okay, so are you guys only doing California or all states?
We can do anywhere in the United States.
Okay, gotcha. Thank you.
Yeah, absolutely. Does anybody else have any questions? All right, doesn't look like we have any questions at this time. So I'm gonna go ahead and forward the slides so that anybody who wants the slides, I can, I can give you a copy as well. But
Sure.
if you,
Well, I should type my, oh, there's no chat not available. Maybe I type on the Q&A side of my email. So,
I'm sorry.
yeah, I said I type the Q&A section about my email, so you can I have the PDF slide?
Yeah, absolutely. So I forwarded to I forwarded to
You can
Legend
forward to
Realty.
me.
Yeah.
Yeah. I will forward to the Harry. Yeah.
Yes. So I've already forwarded them a copy, and your office would be able to send everybody a copy. All right. Well, ladies and gentlemen, thank you very much for joining me here today for a 1031 Exchange webinar. If you do have any additional questions, please do not hesitate to reach out to me anytime. More than happy to help answer any question that you and your clients may have. Thank you very much, and happy Friday, everybody.
Thank
Thank you,
you.
Wenning. Happy
Thank you.
Friday.